is done in terms of what are the various approaches that are there to compute the operational risk and what are the processes that are available to mitigate or reduce the operational risk. So any risk that is existing because of the operations, it could be because of people related, it could be because of processes related, it could be because of systems related, fraud, any such kind of risk that come up within a financial institution's operations. Any loss that a financial institution or a bank is facing because of the operations related issues, they are all getting classified under the operational risk. And there are, Basel has actually suggested 3 approaches for measuring the operational risk. The first 2 are very straightforward kind of approaches, where the first one being a basic indicator approach. It's a very straightforward, where you compute the gross income of the bank over the last 3 years. Annual gross income of the bank, which is annual gross income is nothing but you are computing it as interest income as well as non-interest income for the bank. So directly from the P&L statements of the bank, you can extract it out, the net interest income as well as the non-interest income, and that you are taking it for a 3-year period, the total, and you are taking the 15% on the top of that. Straightforward. That's again decided by Basel, saying 15% of that total interest income, gross interest income, is what is your operational risk. And so, which means even from the total reserves standpoint, the bank needs to have a backup for addressing your operational risk also. So this is the amount they are saying should be the amount that is at stake for the bank because of the operations. Very straightforward computation approach, but again maybe different in reality for different kinds of banks. So the next approach that has been brought out is a slight improvement over the basic indicator approach, which is the standardized approach, wherein instead of directly allotting 15% to all the departments, a small modification has come. The whole banking functions have been broken down into 8 major lines of business, and different weightages are given to different lines of business on the basis of the risk which they typically assume. Some kind of line of business which may not have too much of risk in terms of defaults very heavily, the retail banking part or the asset management or the retail broking part, where the volumes of the risk is not that heavy, the weightage of 12% has been assigned to them. Those departments where there is a high chance, we are talking of operational risk, not the default in terms of credit or anything, the operational manipulation issues. So the operational manipulation issues have been observed across the various banks across the world. It has been observed that in these kind of lines of business, they are quite lesser compared to some other lines, the investment banking lines, which are much higher, where there is a possibility of a fraud and tamperings and system manipulations. Even majority of the downfalls that have occurred, which we will see in our case studies also, majority of the system based manipulations and all, they have occurred in these kind of departments, the investment banking departments of the company. The trading desk has done lot of, or even the trading back office, these have typically done lots and lots of manipulations. Even the settlement services, where some fraud trades used to be entered, or some of the trades were never settled at all. So these are the places where in reality they have observed that they are exposed to heavy risk, and that is where the standardized approach has said, compute the gross income for each of the 8 lines of business separately and multiply them with the 18% or 12% or 15% as appropriate to that particular department is. Otherwise, the basic indicator approach was a straightforward 15% for all departments, for across the bank, easy to compute right from your P&L statement. Whereas for standardized approach, it's not that easy to compute from the P&L statement, because for each of these lines of business, you are trying to find out the gross income for each of the line and then multiplying it by the appropriate percentage to estimate the value of your operations risk. Whereas the third one, which is a mathematical approach, what Basel has been suggesting is, now there are two things that will help you in finding out the size of the loss. One, what it is saying is the frequency of losses, how many losses are occurring in a specific period. And the second part is the severity. Assuming a loss has occurred, what is the size of the loss? Now it says probably you create a model for the frequency. In general, some kind of a statistical distribution can be used to model frequency. The most common distribution that is used is the Poisson distribution for modeling the frequency of losses. So it is more like for having zero loss. See, the typical graph of a Poisson distribution looks more like this, wherein the probability of zero or one risk, one loss is very high. I mean, one fraud, two frauds, the probabilities of them are very high, but probability of 20 fraud, 30 fraud, 40 fraud, their probability keeps going down in a general kind of a behavior. Right, during a specific period, let's say we are talking about a month or something, the chance of less number of losses is very high, and the chance of higher number of losses is very, very less. So typically people felt that a Poisson kind of a distribution is a very good fit to model the number of losses during a specific period. And to model the severity, they generally depend on log normal distribution, because we have seen the shape of it earlier. The log normal distribution will be more skewed towards the right. So the chance of a very high loss occurring, right, there could be one or two losses which are very sizably high. So that is where the severity generally gets modeled as a log normal kind of a distribution. And when these two are clubbed, that is what we are calling as the loss distribution. Typically for the operational risk, when we are talking about the loss distribution, the advanced management approach says you can have your own model for modeling the loss frequency, another model for modeling the loss severity, and multiply these two, superimpose these two to typically create a loss, the total loss size, loss distribution for probably for the whole bank as well as for each business line, which is again on